warm welcome to another episode of ETCFO presents ET Studio CFO Blueprint in association with SAP. I'm your host Divina Lasson, and on this episode we delve into optimizing unit economics for sustainable growth. Now, today we'll be discussing the strategies to balance key metrics like customer acquisition cost and lifetime value, ensuring profitability while scaling rapidly in competitive markets like SaaS and FinTech. So here to decode this and much more are esteemed guests. Joining us today, Akshay Sharma, CFO Axio, and Sandeep UP, CFO SAP India. Gentlemen, welcome to ET Studios. Thank you so much for being here today. Pleasure to have you.
Thank you so much for having us.
Thank you. So, we're here to talk about a very important topic, which is unit economics and really ensuring sustainable unit economics for growth. Love to understand from each of you a little bit of context setting here. Let's kickstart with you. What would you say are some of the really vital indicators to showcase healthy, positive unit economics in a growing organization?
Yeah, I think number one, the most important thing is to make sure that, the business that you're in is working without any artificial pressures,
Yes.
right? So when you're driving basic growth, product market fit, a healthy unit economics just shows that there is demand for that particular product. So when you break it down at a per unit transaction, you are able to see that, right? You're not kind of inflating demand by, marketing costs and a bunch of other things that way. So I think any healthy unit economics will show that there's a natural demand for that particular product, whatever you're selling, right? And I think if you're able to demonstrate that in a single line item or in a single P&L snapshot, that becomes relatively easy for folks to understand. So I think that's an important thing to kind of look for when you're just looking to understand, does this business work?
Absolutely.
Does that mean that is there enough natural demand for this without companies having to spend money, because that's when it starts becoming a little dangerous.
Absolutely. So also, what does it take then to sort of optimize this healthy unit economic structure in, of course, we're talking about a variety of industries across sectors.
Yeah, I think it kind of varies, right? Because it also depends on your growth. When you're young, you just started out, you will have some overheads because people don't know your product, they don't know you. But then that's where the famous economies of scale have to kick in.
Absolutely.
So there has to be a tipping point. So how long is it? A higher CAC in the beginning, but at some point this graph has to start moving down, right? But if it's not, it's only going in one direction, which is up, you're in trouble at some point over there, right? So it varies because different industries tend to have different overheads, different ways of marketing.
Sure.
So, as long as everyone in their industry knows what they're kind of gunning at. But, by and large, if you're running in that particular direction, you know that, hey, this is a number that over a certain time period has to come down.
Yeah.
And you kind of track towards that. I think that kind of play itself out.
Absolutely. Wonderful. Great. Thanks for that. Sandeep, let's get you in on this.
Sure. So if you talk about unit economics, so what are we looking at? We are looking at the cost of acquisition of a customer and cost of retention of this customer. And at the end of the day, does it make sense for me as a company to offer this? Am I making money out of it? Ultimately, it all boils down to the profits. Yeah. So overall, we are trying to see how we can ensure we are offering that value to the customer in terms of whatever he wants and the value for ourselves. So overall, if you don't know the cost of the unit that you're offering and the money that you're making in a unit you're offering, it's like walking in a foggy area with a compass, right? You don't know, you know the path, but you don't know where you're heading.
Yes.
So I think if you know this, then you really know where are you going. If you're not doing it right, then correct it, fail fast, correct yourself and get into the right path. For me, that is how I would sort of look at it.
Yeah, wonderful. What would you say also are some of the common pitfalls that companies face when, of course, the natural direction is going to be to focus on growth? But what happens when you focus too much on growth and not enough on unit economics? How are the challenges panned out in those situations?
Yeah, when you don't focus on the unit economics and just on growth, I think the first thing that you tend to do is that you go and offer something that you can't even deliver. I think first you make that overcommitment because you want customers first. You want to have those logos in your kitty.
Sure.
So you make those offer and say that, okay, this is what it's available. And when the customers start with that and when they don't succeed, then you see you are failing, and that's when you fade away.
Yeah.
Second thing is I see compliance, because when you start focusing on delivering and making money, people sort of ignore compliance. They think that, okay, this can come later. First, let me make my top line, let me make my margin, and then I'll start complying. I think that is where we see this lack of compliance, which sort of leads them to penalties and failures in the thing. The third thing is probably in terms of managing your cash. One is in startups, of course, cash plays an important role.
Absolutely.
Are you able to invest in a place where in a right place? Are you able to make that decision correctly? I think these are the 2-3 things which comes on top of my mind.
Excellent, wonderful. Actually, anything you'd like to add to that?
Yeah, I think.
Again, what does it take to strike that balance?
Yeah, I mean, see, look, when you talk about growth, I think it's important to identify what growth you're chasing, right? Is growth just customer acquisition? Is it customers who are transacting with you,
Yes.
and as a result adding to your bottom line? How much are you spending? How much are you transacting, right? So your classic lifetime value for customer to CAC, which everyone kind of tends to look at. So it's important to kind of, I think, realize when you say growth, what am I going after? Am I going after just blind number of customers as a vanity metric, or is it transacting customers or profitably transacting customers? So as long as you're defining that, and then actions to kind of go after that, and then you will have a series of, let's say, next steps, right? So I'm spending X today to get these guys, but in 6 months I should start seeing something, right? So, but 6 months is a long time. How do you know whether you're on track or off track? So you kind of lay down guardrails saying, okay, if I'm doing X and the customer is transacting Y, in month 1 or month 2, is he transacting Y plus something?
Right.
If not, do I course correct quite immediately, right? So I think any amount of planning that goes in before you actually hit that accelerator is very important to avoid hitting a brake, right? Because growth is important. Traditionally, CFOs are looked at as folks who come in and say, don't grow too fast and you're worried. But everyone needs the organization to grow because there's no point being the finance head of a stagnant organization. You're not going anywhere, neither is the organization. So it's important just to lay down the rules of the game very early, make sure people have the buy-in that if something isn't going on according to plan, they will course correct and not necessarily wait for what could be too late down the line, right? So I think those things kind of help you kind of build those safeguards.
Fantastic, really interesting. What does it take, as you just said, to create that buy-in effect within the organization? What does it really take to ensure that that thought process, that mentality exists at the very DNA of the organization?
Yeah, I think it comes from, I think the kind of perception, at least for us, and the way I've kind of operated is to kind of make sure folks know that finance is your best friend. A lot of folks have a very traditional definition of saying finance as the brake in the company while the business is the accelerator. I find that very counterintuitive because if I'm just hitting the brake, the car's not going anywhere. So I actually like to think of finance as the heart of an organization. It pumps blood going to all parts of the body, making sure everything's circulating well, it's working well, and if some part of the body isn't getting blood like it should be, then you're fixing that problem, right? So for me, it's important that I actually sit down with folks and understand where I'm coming from. I might have a slightly longer term perspective, while other folks are looking at month-end numbers because that's what they're being tasked with. And I got to say that you might win the short-term game, but you're going to lose the long-term game. So then make them understand the pros and cons of it, right? Now, not everyone's going to be aligned on day one, but you hope you kind of get there by day X, right? Which is not too long. But I think those kind of conversations within the org is important so that they understand perspectives. Because it's all about that. Everyone has a role and they have coming from a particular point of view. And if you're able to explain that well enough, I think you will get those buy-ins.
Absolutely. Communication is key.
Always is.
Wonderful.
I think at least the perception of CFOs are changing. Earlier,
you
said we are only hurdles.
Correct. It doesn't work, unfortunately, right? Because I think without necessary buy-in from folks who understand the structuring of the P&L and who can help you design products and its commercials a lot better in, let's say, the most tax-efficient manner for the organization, only then will the company succeed. Because you might have a commercially great arrangement, but if it's structured poorly, your P&L is never really going to show you that gain that you're looking for. And effectively, let's all be honest, financial statements are everything at the end of the day. So you want to make sure you're seen as a partner. And I think like I said, it is changing. People are looking at folks to come in and say, hey, how do we do this better, right? So you're involved much earlier, so you're able to give decisions or you're able to give solutions that actually benefit the organization as a whole.
Absolutely. No, I mean, that's a great point that the role of the CFO is, of course, evolving. But yet, of course, there are certain challenges and hurdles that every CFO faces. Let's talk specifically in the case of managing sustainable unit economics. What would you say, Sandeep, are some of the biggest challenges that you're seeing in the CFO community?
Yeah, sure. I think on top of it, what I can think of is the rising input cost. I think the economic situations, the pandemic we saw, and then the supply chain disruption. If you look at these things, I think they have significantly altered the cost. Whether it's the cost of labor, whether it's the cost of logistics, cost of services, everything has gone up. I think that I see as the first and the foremost challenge. Sure. Then if you look at our own pricing, we spoke about the pricing, so right. So our own pricing today, if we see the marketplace, it is crowded. There is a lot of competition over there. Are we able to offer a right price to the customer? When I say right, it has to be right to the customer, right to us also, because I have to make that margin. And just because there is competition doesn't mean that you sell something at a loss. That doesn't work up in the long term. So for me, that is another thing. And the third thing for me is the data. As companies, we are sitting on huge data.
Absolutely.
Huge data, but how many of us are able to convert that data into decision making? That is another challenge that I see. One more thing that I can think of is the sustainability and compliance expense. So if you see, customers are looking at sustainable practices. They are looking at sustainable vendors, which means we have to adopt those practices. Even though there is no regulation, we'll have to ensure that we contribute to that. And compliance cost, so we can't afford to be non-compliant. So there is a huge cost to that. Apart from that, retaining the talent, that is becoming a challenge today, because while talent is there in abundance, but are we able to get the right skill set for the purpose we need? Question mark. And even if you get them, are we able to retain them over a longer period?
Sure.
That is becoming another challenge. For us, it's important we sort of focus on that. And then, of course, the market volatility. We saw what pandemic did. We saw what the geopolitical issues are causing. How is it interrupting? How are we planning for those? So these are some of the challenges which I can think of.
Akshay, anything like that?
Yeah, I mean, I come from a different world. So lending for me, cost of money is the most important thing. So the inflation hasn't helped. I think we've covered that across the board. So yeah, we're waiting for the rate cuts as eagerly as most folks, even on D Street. But that's important for us, right? Cost of money, and effectively, I think cost of compliance over the last few years. There's been more microscope on how lending institutions are running. So we want to make sure everything's in order.
Yeah.
And then you do have different, like for us, stamp duties on loan agreements keep changing up and down. What ends up happening is you have to pass some of the cost on to customers, which makes the burden on them that much harder. So you're kind of trying to navigate a world where, at least the world we're in, we have manufacturers who want to offer products, but they're not going to go below a certain rate. You want to make sure you're not charging the customers too much, because then you're going to have the good guys kind of walk away from you. So the margins get squeezed from both sides with interest rates rising. A cap almost on what can be charged from the customers. So then you have start finding operational efficiencies within your organization, right?
Yes.
And that's very hard to do because sometimes you end up saying, well, maybe we'll make 20 basis points lower this month. And that, I think, is the biggest challenge that we're facing right now, is consistency in that bottom line. Because of fluctuating overhead costs that are just not in your control, because we're price takers for most of this. To make sure that bottom line is consistent is, I think, quite a challenge right now, because the number of things.
Can I add one more to what you said? And sitting from the other side, because I see this adoption of technology is a big challenge for at least as a customer. I see a lot of them are not able to adopt on time, and thereby the ROI becomes a question mark, and obviously CFOs question that, right? So that is something that I see quite often with some of the customers.
I mean, not for us, because we only serve folks who are in the digitally savvy world. I don't know if it's a good thing or a bad thing, but for me, if you're someone who operates a smartphone and is buying digitally, then you're the kind of person I want to go after, because that's the DNA that we've built and the customers we want to kind of cater to. So I understand where you're coming from in generally across the ecosystems, but for us, like for me, like this is my guy or woman. I'm just like, I want to go after this segment, saying you are the digitally savvy Indian. I want to grow with you as you go through life. I want to make sure I'm there for your financing needs, right? So that's the kind of mental model we take on this.
What role do innovative pricing models play here when it comes to managing sustainable unit economics?
I mean, see, innovative pricing models is, I think, just a fancy way of moving money from left pocket to right pocket. Right? Because end of the day, there's only X amount of margin. Look at the players in the ecosystem, right? You have the customers who are willing to pay a certain amount. You have retailers or merchants who are willing to pay a certain amount of money, and then you have everything that you have. Now, you're just trying to slice the pie in different ways, right? Because you might go to a merchant and be like, listen, why don't you give me a little less? I'll go to the retailer and say, why don't you give me a little bit more? And I'll go to the customer and go like, can I do something else here, right? So in my world, innovating pricing model is very restricted, because I have only 3-4 players to kind of go with, and the rules of the game are fairly defined, right? Like you can't. I mean, obviously, you're not going to go about and charging 75% loans. That's not going to work. So you have to be, you know where your caps are at, you know where it's at. So there might be innovation around structuring, because I think that then allows you to see how your IRRs kind of come through. What quantum can you take upfront versus over the tenure of the loan, so your IRRs get a little better. How can you structure your cost of funds so that becomes a little better? But I think it's very restricted in the world that I'm in. I don't know if you're running a pure tech company, there could be a lot of different permutation combinations you can play over there, because you're not really regulated by someone governing it. Two parties can come together and decide a pricing structure that works for both of them. And then, yes, there's scope for innovation there. My world, I don't think there's scope for innovation that much.
I agree with you, actually. So, like you said, we can only play so much.
Yeah.
So it's only on the commercial offering that you do. What is the commercial structure you're giving? What is the payment terms you're offering? Or what are those boundaries where you can expand? That is all we can do, because at the end of the day, we know how much it will cost, what is the money.
It's a limited perspective. Absolutely. Sandeep, so but in terms of innovations, what would you say are some of the interesting tools or frameworks that you have? And I'm sure, of course, SAP has vast amount of experience here that you can offer to organizations to help them really measure the efficacy of their initiatives when it comes to managing unit economics sustainably, but really tracking those metrics real time, effectively and consistently.
Yeah, sure. So for us, ERP is at the core. So whatever you do, ERP has to be there, right?
Sure.
So when we are into the cloud world, we offer what is called as Rise with SAP, which is a private cloud. Then we have what is Grow with SAP, which is a public cloud. And the startups, we are focusing on Grow with Cloud. So for us, ERP is a single source of truth as far as the finance is concerned. Easily integrates into all applications. I get all the information from the system. It complies with all the accounting standards. We sort of get all kind of reports, real-time data that we spoke about, everything we are able to derive from that. And importantly, if I talk about the unit economics, based on some studies that I've seen, we are able to close the books of accounts much faster.
Sure. Yes.
We are able to save a lot of cost on the finance expense. We are able to save audit cost. We are able to sort of bring new revenue, improve the new revenue because of this. So there are a lot of benefits from this. Apart from this, we use cash flow management and the treasury management. The focus is on how do you manage cash flow, how do you manage your working capital. Then we have what is called as finance operations, focusing on accounts payable and accounts receivable, primarily to see how can I improve my DSO, how can I reduce my bad debts, how can I get the AR faster. Of course, we have AI embedded in that to see which are the customers who are paying late, so that I can focus on those customers to collect first. We have finance consolidation and close, which is helping on the reconciliations, and we are able to close the books on time. Of course, we have this financial planning and analysis, where we are able to set the budgets, we are able to track them, and of course, the machine learning helps also to give sales forecast based on the patterns that he sees from the past, based on the industry updates on the industry, so that even when we check on the forecast, we see what is the machine saying and what are you forecasting. If there is huge gap, why? So we're able to do that. Procurement, our biggest expense for all of us. So with the scale of SAP, we of course use Ariba. The centralized procurement, the kind of saving we get from that because of the centralized procurement, as the name suggests, because of the procurement, we get a lot of savings from there. Then again, if you talk about the T&D, the travel and expense side, we use Concur. We have tie-ups with the airline vendors, we have tie-ups with the hotel vendors, we have tie-up with the taxi vendors. So we have tie-up with everybody, and an employee goes and books everything. We are able to save some money from that. So is with the corporate cards. So overall, there are various tools where we are able to use and leverage them for our benefit and save in the process, which contributes ultimately to the unit economics.
Absolutely. Wonderful. Akshay, as we slowly come to close of the conversation, when companies grow and as they really start to see that growth on a sustainable basis, is there any shift you would say that the business model fundamentally needs to have to make sure that the unit economics are also being maintained sustainably?
Yeah, I think one of the biggest ones that end up happening is one of your core products now starts moving into a money-making cash cow, which every company needs that one cash cow, right? That's doing that. So you should be seeing that. There should be one stable product that is printing your cash, that allows you to go and experiment and innovate and to launch new ones, right? So I think if you're seeing that, I don't mind if the company is loss making because you're continuing to innovate a little bit, but you know there is one product that's kind of printing the cash that is needed. If you're not seeing that, I think there are different problems. But I think as you grow, as you mature, number one is to find that product. So you found that product market fit, and now that's there. And number two is all your efficiencies and scale. Right? As a tech company, for me, I invest very heavily upfront in tech, in-house tech that's there. So as you go from X to 2X to 3X to 5X, beyond 2X, I would love to see that cost kind of flatline,
yes, sure.
right? Because that's where tech should kind of coming in. But if on the other hand, I'm seeing that not play out, that means something's wrong in the way we've built it, right? So you want to go back and fix that. So, some of those core things for me would be as you're maturing is the economy, the scale need to play in. Your products need to be mature over there. And then you kind of go and say, okay, now we can go innovate a little bit more, take a little bit more risk because now the business is more stable. At the end of the day, as young companies, you're here to innovate. You can't stop. The day you stop, the incumbents are going to eat you.
Sure.
So you want to make sure that engine and that part of the business is up and running as well.
Absolutely wonderful. And Sandeep, so what exactly or what specifically is SAP doing to really help and to empower the CFOs to ensure that they can maintain for their organizations sustainable yet profitable yet really stable unit economics?
The first thing is we adopt our own solutions.
Yes, of course.
Because unless you know your solutions, you can't talk to the customers. Right? So that is there. Apart from that, we make use of all the data that we get. Right. So I'm able to. I don't need a controller to give me any data. I just can extract whatever kind of data that I need, so that I have it handy, and based on that, I can take those decisions. So we are given that independence to drive the company in the manner you want. Of course, being a global company, we have our own corporate guidelines, we have our own set of targets to meet. And again, there is no scope for lapse on compliance. But at the same time, we ensure that all the whatever we are supposed to do is going in the right manner within the corporate governance levels.
Yes.
I call myself, or CFOs in generic, as Chief Future Officer. Of course, we have various hats, be it the risk officer or compliance officer or future officer. I'm more related to future officer because we are expected to see what kind of risks will be there as you progress, and how are we able to mitigate that while not compromising on growth and compliance.
Sure.
So I think for me, that is how I look at it.
Wonderful. Thank you for that. So before we wrap, is there one key takeaway you have for all the future CFOs out there who are really looking to grow their company, but again, keeping sustainable unit economics at the heart of their strategy? A key takeaway for our viewers today.
I think for me, the biggest one is to make sure the teams buy into your understanding of how unit economics need to evolve. Because I think the moment you have that, a lot of internal conversations become easier. People don't come to argue with you; they come to find better solutions. And I think that goes a long way because then for a change, the organization is kind of driving towards that one goal, which is trying to make the bottom line better.
Yes.
You don't have folks trying to compromise in one and two. I think if you can get that message across, that will be very impactful in companies.
Wonderful. Thank you. Sandeep?
Yeah. So for me, with any offering, are we able to offer it right? It could be anything. So are we able to offer it right from a customer's perspective? I think that is what is the key for me, because typically what happens is we are there today, tomorrow we are not there. We have only that short-term thinking.
Sure.
But we'll have to ensure that whatever we offer, the customer remembers that, and customer is able to adopt that, and it makes sense for him as well as for us. I think that's what I would expect.
Yes, wonderful. All right, gentlemen, thank you so much. Thank you for being here and sharing all your insights, all your experience. It's been really a pleasure to have you in ET Studios.
Thank you.
Thank you.
Thank you. All right, on that note, we conclude this episode of ETCFO Presents ET Studio CFO Blueprint in association with SAP. But do join us next time as we continue to decode the strategies and insights that define the modern financial leadership. Remember, the blueprint for growth starts with the CFO. Until next time, many thanks for watching.